Okay, so in terms of what we're here for today, like I said, it's about investing for millennials. It's what we call financial literacy seminar for recent graduates. And like I said, it's going to be mostly recent graduates. Our three speakers talking to you. I'm going to introduce each of them before each of them starts. But before I start, just going to say, sort of lay down the reasons why we're doing this and why this is happening. One is because of this issue of financial literacy, which is a global problem. It's not a black or white problem. It's not an Africa or Western problem. It's just a global problem. What is financial literacy? Financial literacy is basically the knowledge and capabilities in personal money management. So basically, how do you handle money? Do you know how to handle money? Do you know how to use money? Do you know how to make money work for you? Unfortunately, these things are not taught in school. We all go through school learning everything else, but apart from how to actually manage money, which is very, very important life skill. I personally, I wasn't taught any of this. I learned it the hard way, made a lot of mistakes in my lifetime investing and doing business. Is because we didn't have any guidance or anyone to mentor, talk to us or put us right. So I discovered all this through the University of the Hard Knock Life. But the aim is to stop you guys going through the mistakes we've all made in terms of beginning to understand money and how money works. So financial literacy is literally the ability to make informed, and that's the key word there. The key word is informed. Is to make informed judgments and take effective decisions regarding the use and management of money. So what's informing your judgments about money? You know, what informs what you do with the money you have? You're all recent graduates now, so you all start probably getting to work, either doing some little business, getting an employed job, getting salary. The question now is, what are you going to do with the money that starts coming your way? You know, what's going to inform your judgments on what business to put your money in, what to invest in, how to spend your money, how to manage your money. And this is what financial literacy is all about. You know, making the ability to make proper informed judgments and take good decisions regarding the use and management of your money. And the three speakers will be giving you their experiences in this light. So you can see from this statistic and article, according to Forbes, the 43%, that's huge. So you can see that 43% of Americans and a whopping 2/3 of the adult world population are financially illiterate. So you can see, like I said earlier, financial illiteracy is a global problem. And you can see 2/3 of the world's population are financially illiterate. You know, they spend money not knowing how to spend it, open savings accounts, invest without knowledge of what they're doing. And like I said, it's a big problem. And the hope is that we can stop you all going down that path and making the same mistakes we've made. Okay, so I'm going to introduce the first speaker who's going to speak and share with you. Like I said, it's not me talking to you guys today. It's going to be your peers who will give you their own perspective, not an old fogey like me who will hear what they have to say. So the first speaker is Dami, who is an architect who has a keen interest in design and solving social issues with a focus on housing, food, and education in Nigeria and Africa at large. He got into investing a few years ago with a goal of long-term income generation and wealth building. And, I personally know Dami, and he's been to one of our investment courses and he's been doing very well. And he's certainly someone that looking forward to you hearing what he has to say. So, Dami, are you all set? You can unmute yourself.
Morning. I hope you enjoy this. Should be fun. Right, so I'm speaking about investing in assets for the long term. And I emphasize the long term there because that is a key thing that some people don't think about when they're going into investing. So for me, a long term is like a 5 to 10 year outlook. And that will kind of like guide my investment decisions going forward. So I'm going to be speaking about finding assets that suit you and making your own choices. Um, so firstly, I'd like to ask, like, who are you and what are you trying to achieve? Those are basic questions, but I really need you to think about that. To make sound decisions about your finances, you need to figure out who you are, right? And what I basically mean by that is you need to think about where you're at right now, what your income situation is like. Do you spend money on things you really don't need, but you just want instead? It's all right to be honest, because I will be brutally honest about mine, so you could see how that kind of plays out and affects your investment decisions going forward. Are you in a position to take calculated risks right now? Or if you can't, can you start to make changes going forward? And what are you looking to get out of investing? It's a vague question at first. I didn't have the answer when I started 3 years ago. But as you go along, you kind of start to figure that out as you go along. So yeah, can you just let me know if you can see the right side of your screen? Because I've got the like panels on my side, so I can't tell.
Yeah,
Everyone's...
I can see.
Okay, thank you. So on the right side, it's basically just a quick thing to try and get you to think about how to like set a straightforward goal.
Oh, no, sorry. We can just see your create PDF, combine files, edit PDF.
Oh, you're not seeing the full screen?
No. We're just seeing the PDF tools.
Let's do this again.
Yes, we can see it now.
Oh, is it better like this?
Yeah, so we can see the topic, goal,
Okay,
outcome.
fine. So I'll just
Yeah.
keep it like that then. Hold on a second. Let's stretch that out a bit. So you can see the topic, goal, outcome, reality,
Yes.
options, way forward.
Yes.
So you don't really have to take notes. This is not really a note-taking kind of presentation, but if you do have a pen and paper, I'll just say make notes of that acronym, because this will like help you going forward in terms of like thinking about how to set your goals out for your investment journey. So now I want you to think about you and what it is you're trying to achieve, right? So how are you doing? Where are you at right now? This is a very key question because most people think about just throwing money into the market or other investment assets and things like that. But a lot of people will tell you that until you kind of have a hold on your emotions, you shouldn't really trade or invest because you could make some impulsive or rash decisions that you might regret going later on. So if you're not in a good place right now, that's fine. But have a clear understanding of where you're at right now, emotionally, financially. What are your habits right now? What are you spending your money on? Where's your money going? All of that. Are there things you can cut out? And if so, can you start to do that slowly? And next up, what's your financial health like? So where are you spending? Where are you saving? Can you account for the last 3 months of your spending? I couldn't do that for the longest time. And do you have a source of income? If not, how can you start to generate a source of income from a job or a business and grow that into other sources? So hello everyone, I'm Dami, if I didn't say so before. I'm an architect, firstly, but I'm also finding out that I'm into other things and I'm a multifaceted human being. So I'm looking to leverage on that into other streams of income as I grow. I realized that I was really bad at saving. And basically what that meant was every time I got money, it just went out every single time. Sometimes I'll call my bank to find out what happened, even though I can see in the statements that it was all me, but I was really bad. And I always blew my money from paycheck to paycheck. It was like, you get paid, you run it, you get paid again. Never end the cycle, which wasn't sustainable. What was I spending my money on? Well, I love to eat out and don't really like cooking. So I spend a lot of time eating out and going to restaurants or just ordering food, which isn't a bad thing as long as you manage it. I loved going out to the clubs, and that was a bad one because the everyone, I mean, people who go out will tell you when you're buying drinks in the clubs, it's always way more expensive than if you got them out of the clubs. I don't know what the extra charge is, but it's not worth it in my opinion. So I kind of stopped going out a couple years ago, and that helped with controlling my finances. But my biggest problem was that I started smoking in the first year of uni. And I did that for about 10 years. I've quit now, thankfully. And this is not a thing. I'm not trying to tell you to don't smoke or smoke whatever works for you. I'm not judging. But for me, it didn't work because that was part of what kept my money going out. I couldn't keep my money in my account anytime. So I figured out where my money was going, and I decided to make those changes. So I was living, obviously that is not what I look like, just these are just images to kind of set the tone. So I was kind of just, the way I was living was reckless, and it made no sense when I thought of how I wanted to live my life independently in the future, travel at any time, visa permitting because I have that green passport, without having to ask for a holiday from work, live in a couple houses around different locations, sort out my kids' futures and all of that, and also support people's lives in the future. It wasn't going to work. So that's basically the reality of what I was living. I thought I was living the dream, but it actually wasn't happening. And I kind of figured out that I needed to make serious changes if I wanted to retire before 65. That's kind of like the basic rule of retirement. Like you work till you're 65. But the way I thought about that was by the time you're 65, you're already gray. You're probably going to live till you're like 80, 90, God willing. And how much time would you really have to enjoy your like retirement? So for me, I wanted to try and get that down, the retirement age. So what got me into investing? I moved back. I graduated from Edinburgh, studied architecture, moved back to Lagos in 2015 to do NYSC, which was a job on its own. And then the recession kind of hit, and that was a wake-up call because the fast life and everything that I was living wasn't sustainable. I wasn't saving anything, and Nigeria was in a mini recession. So that was the first time that I got that reality check. After that, I found out that I didn't have any money to spend on anything I wanted to do besides the basic needs. And that's where things started to make a bit more sense. I stopped going out completely, and I just started to like try to save aggressively from there. So I calculated how much I would have had if I saved my pounds and changed it back to the Naira. I'm not sure what the rate is like today, but everyone knows the pound is stronger than the Naira and the dollar. And then I also calculated how much I had given to my plug. Now, my plug, for those who don't know what a plug is the supplier of my vegetables. I calculated how much I had given him. He was on his third Mercedes. He had a new house. And I realized that I didn't have those things. Now, I didn't give him the third Mercedes or a new house, but I contributed a substantial amount to that. So for me, it was a thing of he's making money off me. I need to figure out how to make money too. So I cut that out. So I started to cut my expenses slowly. It took a couple of years, I'm not going to lie. It wasn't a quick thing. I cut it a couple of times over the years. And from there, I started to talk to the right people. Now, this is something that you kind of learn to do as you go along. Like you find friends and people around you who are about their money, about their business. They've got their careers in check. They save, they budget, all of that. So the more you have these conversations with them, the more you start to realize how you can start to like implement those changes in your day to day. I started reading, and I say a little because for me, I don't like reading. So every time I read, my attention span goes everywhere. So I started to watch videos on YouTube, which are really helpful for those who don't know. If you type anything on YouTube, you can learn pretty much anything. So that was really good for me to like take a lot of information in at the start. And then in August 2017, I kind of started investing in the Nigerian stock market for like practice, because it's not really a consolidated market. So it's real money, but it's not that big a deal right now. Or at the time it wasn't anyways. So I did that to try and like get an understanding of what the markets were. And everyone always says it, like, don't wait until you have a set amount or until you know what you're doing. Just start and then figure it out as you go, because you never really know when you start, but as you go, you kind of make the better decisions. After that, I found out about this app called Moneybox, which basically just lets you, every time you spend your card in the UK on anything from Starbucks to Tesco, anything at all, it rounds it up to the nearest pound and it invests it for you. And I did that for about 2.5 years, and it did pretty well. I closed the account now to put it into other things, but it's a good way to start investing passively. You just pick how like risky you want the investments to be, and you can change the weightings between different things. But besides that, you don't do nothing else. So it's a good way to start. And then in around August 2019, I kind of realized that a lot of the companies in Nigeria that I bought were companies that I knew, but I didn't really understand what they did, and they didn't really align with what I kind of like liked. People always say buy what you know, and that is facts. The stuff you wear, the stuff you eat, drink, those are the things you should start with first. So in May 2020, which is a couple months ago, after doing a lot of research over those years, I kind of settled on a strategy which is basically value investing in dividend stocks. What that means is when the stock prices are lower than normal, they're cheaper, then you buy in. And dividend stocks, I would explain in the slides later on. But that was basically it. Now, most people have a fear of losing money in the stock market. And this is something, especially with most of the older generation, because they had the Great Depression and stuff like that. Yes, you can lose money in the stock market, but from my understanding, you don't really lose the money until you sell whatever you own when the price is down. So on your investment app, which most of us would have today, you don't really have a broker anymore. It would show you that you're losing money, but the moment you sell, that's when you've lost the money. If you just hold for, like I said, a 5-10 year range, it should bounce back up because stocks go up and down all the time. The last week, tech stocks have been going really down, and yeah, don't listen to the noise, basically. And buy what you know. I can't stress this enough. Like things like Nike, things like Adidas, things like Starbucks, Netflix, things that you use every day. You can start with that, and then as you go along, you start to figure out what works for you, and you can start to make more informed decisions. So this is where I'm at now. What do I want to achieve going forward? So I kind of decided this year that I wanted to like be more strategic about what I was doing. I wanted to have financial security to cover my expenses, which is why I focused on dividend investing. Again, I'll explain that in a bit. I wanted that recurring income from the dividend payments that you get. So not all companies pay dividends. There's a few that pay dividends, or there's quite a few that pay dividends. So I only target those ones who pay dividends to pay me some money every quarter, every month, depending on what you invest in. And I intend to use that to cover my expenses and then give me that freedom through passive income to do what I want in my own time. And over time, grow my assets beyond the stock market into other things like real estate and other businesses, because the whole idea is ownership, right? When you buy shares in a company, you have to think of it as we actually own the company now. So you should be more invested in it. Like, I have shares in GT Bank in Nigeria. Every time customer service is not doing what they're supposed to, it upsets me even more because I feel like I actually own the company. So you should always look at shares that you buy like that as well. You own it, so you should study it, see what is happening in the news and how, like, they make different business decisions from day to day. Now, going back to the T Goro thing that I was talking about earlier, this is just to basically outline what that goal setting was. So for me, it's dividend growth investing. That's the topic. The goal is cover my annual expenses within 3 to 5 years, which is doable, but ambitious, but we go with God. Cover my annual travel costs. Usually it's about 2 weeks in a year, 3 sometimes. I'm trying to get that to 1 month and then move that up going forward. 65 to 45, ambitious. But that's why I'm focusing on dividend investing right now. I researched that's how most people who retire lives is through their income from the dividend. Start earlier, there quite early. The outcome, I'll be able to work in my own time, hopefully not be an employee anymore, focus on purpose and do things that I want to do, and have time for family, just something that I really feel is important to me. The reality is right now I have no income, so again, very ambitious. I need to build my emergency savings, and I also need to build a platform to leverage on to go forward. Emergency savings being 3 to 6 months expenses saved away for when you're unemployed, like now. And after that, 1 year to 3 years expenses saved. So that is being moved up as I'm investing. So it's kind of hard without an income, but the key thing is to build a habit before the money starts coming in. So it's pretty much on autopilot once that happens. Next up, the options going forward: build a career in the architecture/construction industry, real estate development, learn to market and sell my services and other products better, and learn how to appraise and develop property. So this is all trying to tie in the skills that I have and skills that I'm trying to learn going forward. Going forward, I want to complete my master's, which is currently ongoing, and identify key players in the architecture, construction, and real estate industry to connect with and learn from. So basically, that's what I was trying to outline with the TGRO acronym. It's just a quick and easy way to try and like be specific about how you want to get your investment journey going. So things to consider: the key budgeting. Earlier I spoke of my money was and how I had clue at the start, and then when I realized it was kind of upsetting. Once you have a budget, you start to really notice where those little 5-10 pounds go that add up over time, and you can then start to make changes where you can and get a bit leaner. Another thing is allocation. So whenever you get money coming into your pocket, rather than putting it all in your savings or putting it all in your checking account, if you split it between different accounts and say, okay, I'm putting this for savings for something, I'm putting this towards investing, I'm putting this just for expenses. Whatever your weighting is, it doesn't have to be 40, 30, 30, whatever works for you. Find the numbers and try and stick to that for a couple months, and then change it as you go, and you find what works for you. Getting some skin in the game. I can't stress this enough. Someone told me she was waiting to save about £2,000 before she started investing. That's a fair goal, but the problem with that is the markets keep moving up and down, and the key thing with investing is time. The earlier you do it, the better for you. You can start with literally £50 or less, and you can add monthly installments anytime, quarterly, weekly. It's up to you. But the key thing is to not wait, just start, and then you learn as you go. build your emergency funds. I can't stress this enough again, because when you money, treat it as it's gone. Like, don't look at it as I have money invested. That's money coming in, and that's fine. That's a totally different thing. But for investing, it's a long-term play. So just treat it as it's gone, and have money set aside for when you don't have a job or when you need to pay your bills or other things, so that you're not put in a hard place. And the key thing is keep learning, keep reading stuff, keep talking to people, watching. I'm like reading a lot of videos, which kind of helps to retain the information as well. There's loads of stuff on YouTube, and there's loads of blogs and stuff to find, to check out. So why do people invest? Mainly it's for capital gains. So profit made from selling, keyword selling, a company, stock, property, or artwork. Now, I don't know if you can see the image at the bottom, but it's from Jay-Z's, what's that song? OJ, I can't remember what it's called now. But basically, he said, I bought art for 1 million. 2 years later, it was 2 million. A few years later, it was 8 million. That's kind of how these things like property, art, they appreciate over time. Stocks, they do go up, but not as well as art. It goes, because it's a demand supply thing, so it goes up, it goes down. But with what I'm trying to do is dividend investing, so I really don't care much about the stock price. What I care about is whether they pay a dividend, how consistent they are with paying that dividend, and whether they pay that through times like the Corona, the Great Depression, the market crash in 2008, and things like that. Those are what I look at. Passive income is the other reason why people invest, which is what I'm going for. This is where you make money work for you. And there's different ways to, you don't have to go through the stock market to do this. You could set up businesses, you could have your dividend payments. Some companies buy their stocks back, which gives you extra money. You can go into renting property out. So you get rental income. You can also get royalties for your intellectual property. A lot of musicians, that's how they make their money, from their royalties. Book deals, publishing, that's how people make their passive income. And the initial stages of building that is hard and it's time consuming, definitely. But the point of that is, over time, it becomes automated. So you don't have to do the whole going to work from 9 to 5, have to listen to somebody tell you stuff. Really don't care about just trying to get paid. You've been putting that extra work in to make your money work for you while you don't have to do anything. What that does, it gives you time to do what you want to do. Travel, personal projects, philanthropy, whatever works for you. So in the past, I don't know if some people may have heard of Rich Dad Poor Dad. It's one of like the first financial literacy books I ever half read. And basically, it kind of just lays out your balance sheet, assets and liabilities. Assets are basically things that put money in your pocket, and liabilities are basically that take money out of your pocket. That's as simple as it is. It's not too hard. So basically what I was doing is, as I got money in, I never put it into any assets. I didn't really have that much liabilities at the time, but I had too many expenses. So it was coming in and going out, coming in and going out. There was no stop gap to keep some money in there. That wasn't sustainable. You can't build wealth over time with that. Now, I'm a bit more informed, thankfully. So I'm trying to make better informed decisions going forward. So I've started with the dividend payments from the stocks that I buy. Again, this is a long-term thing. So it starts off little trickles. You buy a stock for maybe $100 a share, and they might give you, some companies pay between $1 to $12, depending on the company. But not all companies pay, so you have to check all of those things. But you also shouldn't just invest because of how much they're paying, and I'll explain that as well. But the money comes in, it goes into assets. Right now it's stocks, bonds, and treasury bills. Those are what I've focused on now. But there's other things like real estate, like I mentioned. Some people monetize their blogs, blog posts through advertising. People get paid for YouTube posts depending on their views. That's another way. I already mentioned royalties from publishing and music and any other intellectual property. And because I've added loans into your liabilities, because in things like real estate and building a business and things like that, you will probably incur some debt, but this is debt which finances your assets, which then puts money back into your income stream, which then goes back. So it's a cycle of just rather than taking money out now you into your pocket. Over time, it would work. So going forward, I kind of set out a game plan. It took a while to kind of settle down on what it was, but as you go, like I said, you would figure it out the more you read and watch stuff. So I started with exchange traded funds, and basically what those are like, it helps you to diversify yourself in the market. So for example, on between Thursday and Friday, for those who have started investing, you will notice that a lot of the tech stocks, the Apples, the Amazons, Zoom, Google, a lot of them are crashing. And if most of your investments were in those tech stocks, you would be really worried right now. But if you put some money in ETFs and that maybe tracks the whole S&P 500, which are the top 500 companies in the US, or it was an ETF that tracked the financial sector or the banking sector, what that would do is it would spread that money around those companies or those sectors. So if one sector is crashing, the other sector probably isn't doing as bad. If the whole economy is crashing, some sectors will be doing better than others. So it kind of hedges your investment, so you're not losing or as much anytime. I also kept on investing in Nigeria, like I said, and I started buying stocks on the US market. There's loads of apps to use. I use Bamboo, but there's Robinhood. There's free ones and there's ones you pay fees for. It depends on what works for you, the user interface, how much information they give you. But there's loads of apps. You don't really need to call a broker. You can use a broker, but their fees are a bit higher. So that's why I chose these apps. After that, I started going into REITs, real estate investment trusts. So basically that kind of gives you first step into real estate investment without actually buying property. So it's kind of like an ETF that focuses on real estate. It just pulls people's money together like a mutual fund and invests in property for you. And it pays you returns quarterly or monthly, depending on the type of REIT. App that I use that has stocks and REITs, but it's kind of all structured as ETFs, so you can't really pick any of them. It's just 3 different options and you pick them, kind of like Money Box. But on Bamboo, you can pick a lot of all these other options. So I do a bit of both, but I like to just spread things out to see how things play out. Over time, as I start to generate more income, I want to then get into actual developing property, student housing and things like that for rental income. So not to buy and flip or anything like that. I want to buy them, have an real estate portfolio for rental income, for that recurring income over time. Eventually, I want to invest in other businesses, especially in the agro-tech side, because I feel like, one, the population in the world is pretty large. I'm not sure of the exact number right now, but I know the footage. And I know that there's a lot of technology being put into food production right now. And there's loads of apps again and funds that you can invest in that would allow you to invest in farms. And basically, you just put your money in, you have your set returns over a set amount of time. And that's pretty much it. They've kind of made it pretty simple for the average investor. But obviously, read terms and conditions, do your homework, make sure that they're legit companies, because there are a few shady companies out there as well. Now I'm gonna just briefly explain what inflation is. A general increase in price and fall in purchasing value of money. Is every year the money you have cash or in your bank account is kind of losing its value over time by a slight amount, depending on what country you're in. If you're in the US or the UK, in the US it was between 0.1 to 4% because of the corona, sorry. It's now gone up to between 2 to 5%, which isn't that much. In the UK, again, it was between 0.5 to 1.5%. It's definitely gone up now, but I'm not sure of the exact numbers. In Nigeria, however, it's 12.4%. What that means is every year, your money loses value by 12%. So if your money is in a savings account, for example, which gets 3% interest, you're not really going to be getting that much money from it because it's 3% minus the 12% that it's already gone down. So this is a basic example of what that means. The change in price of coffee over the last few years because of inflation. The price keeps going up, but it's the same cup of coffee. So it's the same thing for everything, for bread, for shoes, for petrol, everything. That's what inflation is. And that's why with dividend investing, I want to focus on companies that are growing their dividends over time higher than inflation so that you beat that, because you still get the capital gains from the stock price going up, but you still get the dividend payments to help you kind of hedge off that inflation as well. So to wrap up, I'm focusing on dividend growth investing, which basically these are companies that grow their dividends at a rate that's equal to or more than inflation. Not all companies do that. Amazon doesn't pay dividends. Google doesn't pay dividends. Tesla doesn't pay dividends. Hundreds of companies don't. And you don't have to buy companies that pay dividends. But for me, it just made sense for the recurring income. Most people, when they want to go into investing, they want to buy the Teslas, the Amazons, because that's what everyone's buying. That is fair enough, but again, you need to kind of do your homework to understand what the companies do and why they work for you or don't work for you. There's no point buying shares in companies that you don't know what's happening and then selling them off after. Every company that I'm trying to buy, I'm looking at a 5-10 year margin. So the dividend paying is more important to me than the stock price fluctuations. When I get the dividends, I don't, like I said, I want to use it to cover my expenses, but because initially they're literally tiny payments, $1, $2, $5, depending on how much you have. As you grow and you put it back in over time, compounding, and you keep adding every month like I do, or every quarter, or every year, whatever works for you, it's going to grow over time. And then you can start using that to cover your expenses, pay for travel and things like that. So like I said, I only focus on companies that do that and have a sustainable payout ratio. So what that means is for every dollar that they make, they pay out a certain percentage. The higher the percentage, the more unsustainable it is. So the lower it is, the better for you, because that means that they can cover it depending on how many assets against debt they have. The key factor, like I said, is them growing the dividends annually. Not all companies do that as well. So all this information is easy to find online, but you just kind of have to look for it. One key I've also done is I've had a cutoff mark. So I only look at companies that have paid for the last 10 years, even 25 years in some instances, to see companies that have paid through recessions, to see how they can deal with COVID and other things. There's newer companies. I think Apple is just under 10 years. Coca-Cola is 58 years in paying dividends. So it's just a thing to get you to understand that companies do start paying dividends whenever they choose to. The companies that don't, they reinvest their money into like research and development, which is why Tesla and Amazon don't. But the companies that do, they're just basically saying for every share that you own, here's some money back. And that just works for me. So in summary, you have to set a budget, because until you find what is going on with your money, you wouldn't be able to make informed decisions of how to manage that going forward. So that is key. And then building your emergency fund from there. Finding a strategy that works for you. There's loads of things. There's value investing, dividend investing. There's trading, other things, but find what works for you. Take your time with it, be patient, read about it and learn from people, ask questions, and don't pay attention to the noise. Someone called me yesterday that they wanted to sell their Amazon shares, and I didn't tell him not to because I'm not an advisor, but I asked him why he bought it in the first place if he's going to sell it because the price is going down. So those are questions you need to ask yourself. And spread your risk to avoid being in the position of my friend and myself. Buy more ETFs, and yeah, good luck. Thank you.
Thank you very much, Dami. Oh, no, that's a quote. You've got a quote there.
Sorry, that's a quote by John Bogle. It's basically just talking about ownership and how your dividends and earnings growth kind of is his way of doing things. There's other ways, like I said. And yeah, thank you.
Brilliant. Thank you very much, Dami. That's awesome. Like I said, we'll take one or two questions before we introduce the next speaker, Ray, who will be sharing her own perspective on things. But Dami mentioned some very, very important and key points, which I just want to highlight. Number one, what I love about what he said is that sharing from his own experience is how sometimes, and we've all done it. I mean, we've all done it when we're, I've been young myself, like they say, so I've been young too. So, you know, we all get to that point where we're just making money and spending money. You know, we're just making it and spending it, making it and spending it without, you know, thinking about the consequences of what we're doing. So that's why I like what he said, is that, you know, at least he got to a point whereby he decided that, you know, this has to stop, begin to look at how he's spending his money, how he's, where this fund's going, what is happening to it. And I think those are very, very crucial points. Also, the important thing he mentioned was the mentality. I think, again, we all brought up to go to school, read very hard, get your degree, get a job, work hard at your job, retire and die. So, you know, we need to sort of change that mentality, and you all have to start thinking ownership, like Dami rightly said. You have to start thinking ownership, you know, start thinking, okay, yes, it's good to get a job so you can get an income. It's good to work and get an income, but that's not the end goal. The job is there to get your income, and when you get the income, it's for you to start building your own wealth, creating your own income streams, thinking about ownership, owning stocks, owning a business like he's rightly done. He's got a goal, you know, to have business in the agricultural sector, in real estate, diversifying in stocks. So these are all great things that he shared, that, and I hope everyone would take that on board in terms of beginning to think about their future, beginning to think about how they're going to spend money and what they're going to do. So that's great. So any questions for Dami before we go on to the next speaker? I can see you all giving him a big thumbs up and thanks. So everyone has enjoyed your presentation, Dami. Picked up some tips. So, well, you're going to become a financial advisor now, Dami. But like I said, so thanks for that, Dami. But like I said, we'll still have time for questions after all speakers. So if you think of another question or questions come up with Dami later, you can ask it afterwards. After all the speakers have talked, we'll still have time for questions and answers. So thank you very much, Dami. Well done.
Thank you.
Pleasure. Okay, so our next speaker, it's Ray Olutume. Ray is, well, she's more or less family. She's more or less family. So Ray is a first-class law graduate. You know, she's having recently completed her legal practitioner course and master's. So she currently works as a paralegal with international record label. Rere has been a wonderful scholar and student from investing, and she's been taking up everything I know about investing. So she's now a master investor herself. So I'm just going to get Rere to share her own experience and story with you guys, and see what you can learn from her. Do you want to? You can unmute yourself, Rere. Do you want to mute? Do you want to share your screen, or you just want to talk?
I'm just going to talk.
Okay, go ahead.
My name is Rere. I am quite new to the investing life, so mine is going to be a lot briefer. I'm just going to give my perspective and kind of what I've learned so far and what got me into investing. So as Remy said, I'm a recent graduate, so I graduated in 2018, and then I did my master's in law school last year, so then I've just started working this year. So I guess that's kind of why I've been considering it more, because now I have like some, but as Dami was saying before, you don't actually need really like a huge income or anything to get started investing. But I guess I've always kind of known about the stock market, like what it is and stuff, but it just didn't interest me, or I wasn't motivated to look into it more. I just thought it was like a lot of numbers and things like that. And I'm just always been awful at maths, so I just thought that's for me. However, like I finished law school last year, I just had a lot more time to think about how I wanted my life to go. And I think I started reading books such as Rich Dad, Poor Dad, which also Dami mentioned, and it just kind of emphasizes how if you want to live like a financially free life, you can't just be dependent on your 9 to 5, and that you know, it's kind of silly to remain ignorant on these kind of things when they can help you to live the kind of life that you want. You know, as Dami also said, have more time for like your family and things like this. So I think Rich Dad Poor Dad was really insightful in the sense that it opened my eyes to how the majority of people literally do spend their lives stuck in the 9 to 5 rat race and not being able to you know, live the life that they want. And it highlighted that if you learn to invest, you're able to work your day job just because you enjoy it, rather than because it's literally just to pay your bills and things like this. And yeah, so I just realized that I didn't want to live my life paycheck to paycheck. And I think, as I said, that investing offers a way out of this. And I've read a few other books similar to Rich Dad Poor Dad at the time, and they all reiterated the importance of having multiple streams of income, and that, you know, kind of not having multiple streams of income just means that your life is going to be more restricted than perhaps you would like. So I did feel really motivated by those books, but they don't actually offer too much practical insight into how to go about it. Like, you kind of read it and think, okay, this is what I want to do, but where do I go from here? So Alex Berman said that I was just a really good student, just pestering him all the time, asking kind of for tips on how to go about it. And, you know, I'm really grateful for that. And I was speaking to him for a while at first, and he said that one of the most low risk ways to invest is to invest in index funds, because it kind of eliminates the pressure from having to choose specific shares. You're more invested into like a pool of shares, so it kind of spreads out the risk. And it also means that you can just invest like a small amount of money. So I think I started off investing like £30 a month, but this is subject to like what you want. You can invest whatever you want into them. There might be a minimum based on where you choose to buy your shares or where you choose to invest. So I think I invested first in Fidelity UK, which is a type of index fund. And, you know, as I said, it was affordable to me. And yeah, so as Dami also said, like, to get involved in investing, even though you don't have a lot of money, even though you don't need a lot of money, it's useful to budget. So I think as I started work, and that's something that I definitely have implemented into my life. Now, I also like to have fun, but, you know, you have to to budget, because you'll kind of have to look at life like more than just immediate gratification. You have to think of, you know, how you want to live in the future rather than just for the now. And I started like implementing. So I have like a budgeting spreadsheet so that I can track my finances more closely. And yeah, so when I started like researching about investing this year, I didn't actually plan to go into it straight away. Kind of like I wanted to like spend more time researching and understanding what it actually entailed. But I thought that you know, with coronavirus, it was too good of an opportunity to miss. You know, stocks were going down, and I just thought this is a really good opportunity. Like, what am I actually waiting for? Especially, as I said earlier, you don't need a lot of money to start, so it was just kind of procrastination. I thought that this was like a good opportunity to start investing. And so I bought a few individual shares on top of investing in just the index funds. So I think I bought them in different countries and also in different industry sectors. So I think I bought one in the pharmaceutical sector, one in technology, etc. Because that's another really important aspect of investing. You need to diversify where you put your money, so that if one industry sector goes down or one country is doing really badly, you're not losing all of your money, or you know, it just balances out a bit more. As I said, I'm still new to this, so I still have a lot to learn, and I'm yet to reap the rewards. But as Dami said, you have to go into investing with a long-term outlook, and you can't expect to make loads of money straight away. You kind of have to put the money away. Like, it's not that you kind of not forget about the money, but you just kind of see it as, okay, this is something that is going to earn me more rewards in the future rather than the immediate. So I'm not worried about not having made a significant amount of money like in the immediate. So just to reiterate, you should start with as little or however much you can afford. And as long as you research the company thoroughly and, you know, consider specific factors, for example, the PE ratio, which, you know, you can look more into these things on like YouTube. There's so many resources available. There's like different books out there, like The Intelligent Investor. You know, there's so many ways that you can inform yourself and educate on these kind of things. And a lot of people do have different ways of different strategies when it comes to investing. I think the one that Dami mentioned about investing in undervalued shares is one that, you know, is pretty low risk in terms of you know, the risks that are out there. So I think investing isn't as risky as it first seems. Like, it's more difficult than you think it is to actually lose money. And I think, like, the older you get, and like you realize that, you know, without risk, there actually is limited, like there is less reward in life. You kind of have to take a few risks in life. I personally use Hargreaves Lansdown to choose my shares. It's quite a good site in the sense that you can find out a lot of information before you actually purchase them. But you know, I know that there are some cheaper ones out there, because with Hargreaves Lansdown, you pay a fee when you buy the share and also when you sell it. And I know that there's ones that have lower fees. So that's something that you also need to look into when you're thinking about going down this route. I think it's also good to have just general commercial awareness about what's happening in like the business world, because then you have an idea of what industries are doing well, and you know, what's actually happening in the wider marketplace. So I often listen to podcasts like Wake Up to Money and podcasts like that, just to kind of inform my wider commercial awareness. So I do also believe that you need to have an element of self-discipline and consistency when it comes to investing, just to kind of keep aware of what's going on, and, you know, keep track of everything like that. And I think that's just a good trait to have across your whole life anyway as well. But yeah, as I said, I'm just going to be short and sweet. That's it really. But let me know if you have any questions, and thank you for listening.
Brilliant. Awesome, Ray. That was great. And I love what you said about, which is, I want to highlight that point, which is what you said, which is very, very important. Like you said, yeah, we don't expect all of you to live a boring life, you know, do have some fun, but, you know, obviously don't spend all your money on having fun. So yeah, you know, life is short, so, you know, enjoy yourself. You still need to go out, have fun with your friends, go to restaurants, go to parties. But again, it's not a question, it's just thinking about doing it, you know, wisely. So it's not spending 100% of your income on having fun. You know, have fun, but have an eye on saving some money. And like, again, you rightly said, Ray, is about, you know, making a budget. You can have your spend budget or your fun budget, and then your investing budget. So those are very awesome points, Ray. Thank you very, very much for sharing. And we hope everyone will become like Ray now. You have a bit of fun, but also invest. That's the best way to go. That was awesome. Thanks. Right. So we'll go to the last speaker, and then, you know, after the last speaker, then we'll just open the floor up for questions, and then we'll then round up for the day, so to speak. Okay, so the last speaker is Ransom FA. Well, that's his trade name, FA. FA is a full-time musician and TV personality with a keen interest in not working for money, but making money work for him, which is what I pray everybody will do. Ransom FA is doing very well in the music world, and I've watched quite a few of his videos, and I've told him that when he gets his Grammy nomination, he needs to invite me over for, you know, to Los Angeles for for the show. All right, Ransom, do you want to share your screen, or you can unmute yourself? Oh, I hope he hasn't dropped out of the call. Oh, it might have dropped out. Let's see. So like I was saying earlier, that the aim of this session was just to enlighten and expose everyone to the importance of becoming financially responsible, begin to learn how to manage your funds, begin to think about diversifying, to begin to think about investing. Like I said, it's a session meant for recent graduates, and it's also by recent graduates, to hear from people like Dami and Ray, who are recent graduates, and to, you know, hear things from their perspective, not, like I said, not from an old man like me's perspective, but hear from their perspective on what they've been doing, what they're planning to do, the goals they've been setting. And I think it's a journey that everyone can embark on, to start to think about how well can I start to plan for my future. Because like Dami said, if you want to retire early, which was interestingly, that was my goal when I started with this when I graduated from university, from medical school. When I graduated from medical school, my plan was not, from day one, was not to be a doctor till I die. Although I enjoyed the medical profession and I enjoyed practicing as a doctor, but my plan was always to leave the medical practice and retire at the age of 55. So that was always my goal from day one. Right out of university, my plan was to create multiple streams of income and retire at the age of 55, and also quit medicine so I could enjoy myself. But like I said, because of lack of mentorship and lack of guidance, I had to go through a lot of expensive mistakes. I had to make a lot of huge mistakes. I made a lot of money, but lost a lot of money. I made millions of dollars and I also lost millions of dollars. because, you know, when you learn through the school of hard knocks, it's a very expensive way to learn how to do these things properly. And the hope is that, you know, we, you know, haven't been there, done it, got the t-shirt, made all the mistakes, is to try and avoid everyone else, especially you guys who are just recent graduates, to avoid you making those same mistakes. So that's why we're doing this session. And again, to hear from your peers. But like I said, at the end of this session is not the end. We still have this website. I created an online platform, which, like I said, I will share with you all. I will send you an email after this session with a link on how to join. So if you have more questions for Adami and Rere, you can ask it on the platform. If you have questions for me, you can also ask the questions on the platform. Let me just quickly send the link to this website. Although when you see the website, there's a long process to join, which is it's intentional, so that, you know, we just don't want anyone joining and causing a problem on the website. We want serious-minded people to join the website. So when we send you the email at the end of this session with a recording, we'll also send you an invite link. The invite link will enable you to join without having to go through any long process. So that's the website I just put in the chat box, but like I said, an invite link will be sent to you all that you can then join the platform. Like I said, it's completely free. It doesn't cost you anything, but it just gives you a forum to ask me, Dami, Riri, or any other speakers more questions that you might have, or things in general. The site is temporary. We're just going to have it up for about 4 to 6 weeks to give you all the opportunity to keep in touch, ask as many questions as you want on the platform. You can also access the platform via an app, and the details are at the bottom of the website, how to access it via the app. So you can either access it from the website itself, where you can sign in once you've created an account, or you can access it through an app. And like I said, it's just going to be a temporary site for about 4 to 6 weeks to give you guys a chance to interact with myself, Dami, and Riri, and ask all the questions you want. And like I said, depending on how things go, we can either just shut down the site after 4 to 6 weeks, or we make it permanent. We'll see how it goes. Okay, so let's see. So if you have any questions, you can either raise your hands to ask your question, or you can send your question through the chat box. I'll just go through the chat box bit by bit, and we'll take questions now. So any questions you have for me, Dami, or Riri, you can go ahead and ask your question. Let me just go through. I'll start from the beginning of the chat box and walk through it. That way I don't miss out on any question. And then, like I said, we'll keep hoping that FA joins us or rejoins in the meantime. Actually, let me do it the other way around. I'll go from the bottom and go up. Okay, I understand Dami explained it's good to buy stocks for trading or dividend investing. What are the signs it's time to sell your stock against holding on to it? That's a question from Ebuka. I think, like Dami correctly said, it's what was your objective in buying the stock in the first place. So like he correctly said, you first have to have decided what was your objective. So if you're buying the stock for the long term, then you shouldn't be panicking in the short term when things are happening, because like he rightly said, the market goes up and down. There's so many things that affect the markets in terms of investor perceptions, economic conditions, competition in the market. You know, like he correctly said, there's a lot of noise in the market. But you find that over the long term, the market tends to go up. I mean, I have been trading and investing in the markets for over 20 years. So I have the the insight of having actively been investing in the markets for over 20 years to know that, you know, all this craziness comes and goes, but you find that over the long term, the market is always on the upward trend. But yes, on a day-to-day basis, on a week-to-week basis, on a month-to-month basis, it goes up and down, and you can get a heart attack trying to follow it very closely, which is what trading is all about. But if you invest in the long term, you find that in the long term, it tends to go on an upward trend. So you always have to ask yourself what your objective was. So if your objective is to invest for the long term, like Rere and Dami rightly said, if you're looking at, you know, 3 to 5 years, then you should not panic. If you buy stock today and you're expecting to make a lot of money in a couple of weeks, then well, that's where you're going to get stressed out. And that's trading. So you have to be careful. So I think that's really the key in terms of knowing the signs it's time to sell your stock against holding it. But yes, of course, there's sometimes, for example, if you bought, let's use Amazon as a good example. Let's use Amazon. So if you bought Amazon shares, and like Dami just shared with you earlier, over the last couple of days, Amazon shares, all the tech shares have been falling. Now, if you had bought Amazon shares for the long term, then you shouldn't panic and sell if you bought it for the long term. Now, using the same Amazon as an example, if you bought Amazon and the shares were falling, and then you find out that Amazon is going out of business, that's a different matter entirely. So if you now find out, you know, Jeff Bezos is going to quit Amazon, he thinks there's something fundamentally wrong with Amazon, they've lost all their business, there's a new competitor in town who is taking up all their business ideas, and they're now losing market share, and the company is in turmoil, there's a lot of scandal, there's a lot of things going on, and the company is going to really go out of business and cease to exist. Now, that is a different matter entirely. So if there are concerns that that company is on the way down and is not going to exist because fundamentally their whole business model has collapsed, then yes, you might want to get out of that stock and sell it and take off. But if you find that, you know, yes, the shares have fallen a bit, but as we all know, Amazon is still very competitive. They're still the dominant player in their field. And if you're doing it for the long term, that's the key word, for the long term, then you don't panic with all these short-term things that are happening in the market. So really it's putting all that into context in terms of whether you sell a stock or you hold on to it. Let's see, let me keep going. I'm going from the last question and working way back up. Oh, let me just actually quickly put in the chat box the invite link, but like I said, it's going to be emailed to all of you. That's the invite link for you to join the online platform for free and easily. So I've just posted the invite link into the chat box. But like I say, it will also be emailed to all of you at the end of the session. And like I say, we can carry on the discussions afterwards. Let's see, let me just quickly go up this chat box. As a starter, what book would you recommend I read to learn basics about financial literacy? Also, why did you decide to invest in ETFs instead of stocks? Adi, I don't know if that question is for Dami, because she was saying, why do you decide to invest in ETFs instead of stocks?
Hello?
So yeah, I can hear you. So I suspect that question is for you.
Okay, so firstly with the books, Rich Dad Poor Dad.
Yeah, I will second that.
Most people have read.
I will second Rich Dad Poor Dad. That gives you a very good mindset. Yeah.
Dr. Remy also has Trading and Investing for Beginners.
Yeah, but I won't recommend that one.
Okay. I mean, because I learned some key terms from there.
Yeah.
Definitely
I'll recommend the courses I do. The courses I do, I'll certainly recommend that because that gives you a very good insight into all this. But the book might be a hard read if you're new to investing.
all right.
My book,
And then,
but not Rich Dad Poor Dad.
I'm gonna get back to you on the books in a second, but in terms of why I picked got into ETFs as opposed to individual stocks, I kind of did both. So I picked stocks that I knew, like I said, stuff that I use regularly, just because it's easier if most of your clothes are Nike or you watch Netflix, just things you use every time. That's a good place to start. But the reason why I picked ETFs was, like we already said, is to diversify your risk. So there's ETFs for pretty much everything from the whole entire US market, Asian market, UK market, to individual sectors like the financial sector or banking sector specifically, or energy companies. So what that does is, like I said, on Thursday, Friday, a lot of tech companies were falling rapidly, but some of the real estate companies weren't doing too badly. So if you had invested in a real estate ETF or an ETF that tracked the whole market, what that meant was, if Amazon, Apple, and everything was down 10 to 15% on your ETF, depending on how much, because each of the companies are weighted differently under that ETF. So Amazon might be 10% of that ETF, another company might be 5%. Depending on how much is in that ETF, you may only be down 2%, or you may not even be down at all, depending on how the other companies in that fund are doing. So it basically just diversifies your risks. So you don't have to pick individual stocks. And I'm pretty sure most, if not all, ETFs do also pay a dividend. So that's another thing. But it just helps you to hedge your bets so you're not exposed to one company falling out. There was a company called Hertz that, because of a lot of people not having much to do, a lot of people who bet on sports games and stuff, they didn't have much to do, so they came into the stock market. And basically this Hertz company is bankrupt, but it's still on the stock market. And now people are trading that stock, so the price is going up. But like Dr. Remy said, that's not a company that you want to put your money in because they're bankrupt. They're not coming back. There's no miracles happening, but people are still buying the stocks. There's going to be a point where it goes back down. So that's why you should look into the individual companies, yes, but to balance out your risk, look at the ETFs as well. There's hundreds of them. If you just literally type ETF, you'll find a lot of them. I hope that answers your question.
Yeah, awesome, Dami.
And I'll type the books in the message, sorry.
Yeah. And ETFs just stand for, everybody in general, ETFs just stand for exchange traded funds. That's what ETF stands for, exchange traded funds. So basically, like Dami rightly said, this exchange traded funds is just a vehicle. It's a financial vehicle or financial tool you can use to invest in whole industries or whole sectors. So it basically makes investing very easy for people. So if you, just like Dami said, if you want to diversify and you say, okay, I would like to have some investments in the oil and gas sector, I would like to have some investments in the healthcare sector, I would like to have some investment in the real estate sector, I would like to have some investment in the tech sector, but you're not sure what shares to buy within those sectors, you can just buy an ETF that tracks each of the sectors. So you can just buy an ETF that tracks the technology sector. You can buy an ETF that tracks the healthcare sector, ETF that tracks the oil and gas sector, ETF that tracks UK, that tracks USA, that tracks Germany. So that's the beauty about ETFs. They help you diversify your investment portfolio without having to stress yourself looking for individual stocks within those industries. But again, picking individual stocks too can have its advantages and disadvantages, same as ETFs. All these things have pros and cons, but I think Ray too also mentioned that, you know, although they have your pros and cons and there's some risk involved, you can manage the risk, but like Ray rightly said, you know, you do have to be prepared to take risks. And actually, this is the time to take risks. You don't want to be taking risks when you're 65 years old. That is not the time to be taking risks. But now that you've got age and time on your side, this is the time to take risks. But you take risk with knowledge, information, and what we call calculated risk, where you take it with objective information and assistance, where we'll, like I said, that's what the platform will be there for, just to give you some assistance and guidance. But yeah, this is the time to take risks for the long term. Any other questions? If you have any questions, you can either raise your hand or send your question through the question box. I think the last speaker has disappeared for good. I don't know if he's had a permanent problem with his internet. Like I said, unfortunately, he was on the call. He was patiently waiting to speak, but for some reason he's disappeared just before we called him up, and he's still not back. So I think he might have a permanent problem where he is getting back up. So any questions before we close? So if you have any questions, you can either type it through the chat box or you can raise your hand and we can unmute you and you can ask your question. But like I say, if you don't have any questions, we'll round up. We'll let you all get to enjoy your weekend. And like I said, the recording will be sent to you all later on today, along with the link to join the online platform. And like I said, we can carry on the discussion but again, actually, I'll just repeat, the platform is free. There are no charges. It's 100% free. So you can also share the invite link with your friends, colleagues, or anyone you know who might be interested and serious about learning. The platform is just to discuss about entrepreneurship, setting up businesses, investing, and all that stuff. So the platform is not to discuss Arsenal, Man United, and stuff like that. So it's a platform for social entrepreneurship, so to speak. So yeah, we can have a bit of fun, but it's largely to talk about money, business, and investing and stuff like that, as it says on the website itself. So it's not Facebook where we'll be posting pictures of dogs and kittens and, and stuff like that. So we're going to take it serious, and it's meant to help, assist, and educate everyone. So yes, feel free to share the website and the invite link with people you feel will benefit and serious about wanting to learn more. So it's open to everyone who are recent graduates. Don't share it with your grandparents. Or your parents. Your parents and your grandparents are not welcome. It's just for youngsters and the young ones, recent graduates. I mean, even people who are still in the university, you can share with people who are still in university if they want to join. Recent graduates, and recent graduates, I would say really anyone who just graduated within the last 10 years is fine. But if you're like me and you left school, left university, gosh, when did I graduate? I graduated in 1991. So how many years is that? God, that's a long time ago when I graduated in 1991. So I think I'm allowed to be the only oldest person on the platform. So I'll be the only oldest person on the platform, just to moderate things and to be the bouncer, so to speak, if anyone is out of line. And of course, to give advice and guidance. So yes, you can share with your people in university, your peers, recent graduates up to 10 years, but don't share with your parents, don't share with your uncles, don't share with your grandparents. They are not welcome. We have another site for your uncles and your aunties and your grandparents if they want to if they want to join. Let me quickly get to that one, since this is recorded and they might see the recording. So we have another site for more or less the adults. So they can join this site. But unlike you guys, this site is completely free. But we charge your parents and your uncles or your aunties. They're not going to get anything for free. So they have to pay for this one. So they're not going to get that for free. But this one is for free. And obviously, you can find out more about us on our website at NextGenFLX.com. Yes, Datola, well done. That's new era only. So just like Datola said, new era only. There's a question here. Is it possible to have such webinars a bit later in the day? Yeah, maybe. Again, this is the sort of things you can bring up on the platform. Again, this is actually why I created the platform. You can suggest things on the platform. We can create another session for another day, another time, depending on what people want. So again, this is the reason we set up this platform, to find out what you guys want, what you need, and what I can do to help you all. So you can bring up all of that on the platform. Okay, so if there are no questions, thank you very much, Riri. Thank you very much, Dami. Thank you for your presentation and imparting knowledge. It's been wonderful. And wish you all a wonderful weekend, and we'll catch up with you all on the platform. So have a wonderful weekend, everyone.